think I'm seeing a bug here.
All right. When we're going to be talking about the SPY single leg dashboard again today, right?
Hold on. Well,
All right.
I'm seeing a bug. So let me skip that one until we fix it. So I'm gonna look at a different report right now. But let me share my screen.
All right. Take over.
Okay, so let's come to SPY and let's look at the multi-legs for now. Because I do see a bug that I want to fix first. So I'm going to go to the multi-leg trades in SPY. And what this, sorry, I overclicked. Let me come back to it. I go under options. We have these multi-leg trades. And I'm going to close this for a second. And what this report does up here is it scans the options trades on the particular stock you're on. So in this case, we're on SPY, scans all the option trades, and it filters out those trades that were involved or entered in as a multi-leg trade. So if you enter in orders to do options, you can enter in, buyers sell a call or put, and that's a single leg trade. However, most brokers allow you to enter in a complex order or multi-leg. So it will, let's say you're doing a call spread to say, I want to buy this call and sell this call, but it has to be done and executed simultaneously as a spread. And when you do that and it trades, that trade itself, each leg gets reported as part of a multi-leg trade. And when that happens, it gets reported, you get both sides of the trade, and then you have to make an interpretation from the trade table. What do I think happened here? Right. So if you're seeing, two trades, part of a multi-leg trade, one's the two calls, one's on one strike, one's on a different strike, and they're at the same expiration. The most likely scenario is that it was a call spread. And now you could do that manually. You could go through there and try to make all those interpretations yourself, and organize it. Now, of course, that itself is a very complex and difficult process to do manually. And especially if you have millions of trades to look through a day, it would be impossible to do it manually. So you would need some assistance from a computer where you could compile that data, take that data, run an analysis, and make an interpretation what the most likely strategy was in this scenario, and then keep track of it. So this is what this is doing for us. It's looking at the options trades, isolating the ones that were multi-leg, figuring out for us what occurred, and making interpretation. This is what the most likely scenario was. Okay. So this is an SPY, and you could see here, this is yesterday's July 31st. If I click this open, you see that we detected lots of different types of strategies, 72 different types. So strategy itself, right? It could be here a put spread, could be a call spread, could be a put butterfly, ratio
What
call.
is a seagull with a put spread?
There is a seagull with a put spread over here, and all these are different types of strategies that are, have. Now, of course, you could create a strategy that doesn't have any type of identification, because it's not might not be something common or something that is written out there about, right? But call spread, put spread, butterfly, ratio call spread, diagonal call spread, these are strategies that you could find literature on. You could go and go in textbooks or whatever, and you will see these strategies talked about or somewhere online. So some strategies are, strategies that are out there talked about, and they're more common, have literature out there that you could read about. Now, of course, I could create a 10-leg strategy nobody ever heard of. And that's just a customized strategy. All right. So these we're trying to filter out the strategies that are, that exist out there, and that you could read about. All right. And you could see here, put spread, call spread, put butterfly. We have like just in SPY, we identified 72 potential strategies. Okay. Box, spread, strap, all these. And next to those strategies, put spread, we could see that there are a total of 387,068 option contracts involved in that put spread strategies. So now we could get an idea what percentage of all the contracts, 1.2 million contracts traded involved in multi-leg trades, 387,000 of them are involved in put spreads, right? So we could kind of get now an idea of the breakdown or distribution of, what's popular, how are people using it, how are people trading in SPY. So yesterday, if we just looked at the volume, put spreads made the top of the list. The next one were call spreads, 227,000. Then a put butterfly, 208,000 contracts, and so forth. So we could see how the volume is distributed along different strategies. The other popular way to look at it is, well, how many different types of put spreads traded in SPY? There's 387,000 contracts involved in put spreads, but if you trade put spreads, you'll know that there are different combinations of put spreads. You could do a put spread in August expiration or September expiration. You could do it in a different expiration, and you could do different strikes. You could do an out-of-the-money put spread. You could do a put spread that has one like at the money, one out of the money. You could do different strikes. So there's not just one put spread combination in SPY. You're not limited to that, right? It's not like a stock in SPY. There's only one stock. But in options, we know that you could have many different put spread combinations. So that's what this is over here, the unique combinations over here in put spreads. 2,860 different unique put spread combinations traded in SPY. And this gives you an indication, another indication, well, what strategies are popular, right? Well, it's not just volume, because I could have one trade with one big volume. Like this could have been just one trade, 387,000. So it's big volume, but that doesn't mean that it's very popular in terms of different people or combinations of trading. So the unique combinations gives us another indication that, well, in SPY, put spreads themselves seem to be a popular strategy. We had 2,860 different combinations that we detected, 387,000 different option contracts. So if you're trading put spreads, or if you're interested in put spreads, you could see that there's lots of trading going on in SPY regarding put spreads. And we could go analyze them and see if there's this particular one that you may be interested in. And you could analyze it, and then you could even get insights where it's trading, what type of volatilities, how where it's trading relative to the bids and offers and so forth. So here, the next one is call spreads. We could see that it is popular, not as popular as the put spread yesterday, but still has significant volume with 1,942 different call spread combinations. Okay, so what I mean by comment here, let me click on this. I'm going to click on the call spreads. So here we go. Now I filtered out all the call spreads. So you could see here, the top one, 27,280 contracts, traded between 350, 456. It was one trade, but the call spread was in September 20th with the 565, 585 strike, right? So that's a call spread, September 20th, 565, 585 strike. Beneath it, we have a call spread, August 16th, 553, 555 strikes. You can see those are two different spreads. One, they're different expirations, different strikes. That's two different types of spreads. Look at this one, August 9th expiration, 565, 570 strike. Now that's a unique combination as well, but you could see that spread traded 139 different times yesterday. So if we open that up, let's get the details. So here are the timestamps of this trade. So you can see here a lot happened 356.34, but some traded 942 as well. So if we go back, we could go back, we could see, it traded at 304, 257, 139, 138, and at different prices. So this particular spread, right, traded many times throughout the day, different volumes, different prices, different times. Okay, that's what this is indicating to us, this particular spread. I'm going to close that. Let me go back to the top here, up here, and then we'll come back down here. So I'm going to just review what's going on up here. So here you see another one, the third one down, put butterfly. So this put butterfly had 208,000 different contracts involved. Now, put butterfly is a little bit different than a call spread because what is a put butterfly? It involves 4 legs. It's not 2 legs, it's 4 legs. So you'll have just the strategy itself involves more contracts, right? A put butterfly involves more contracts because it's a 4-leg strategy. A call spread, put spread is a 2-leg strategy. But here we see that it traded 208,000 total contracts, and the unique combinations were 151. So it did trade a lot relative to contracts, but as far as different unique combinations, a lot less. You could see 10 times more, even more than 10 times more on the call spread and put spread. So if we click on it, just put butterfly, these are all the different put butterflies that traded yesterday, and the one that sticks up top, this is sorted by volume. The one that sticks out the most is this one between 10/19/43 and 11/47. We saw 200,000 contracts total traded 4 separate times in this particular put butterfly. What's the put butterfly? It's October 18th expiration. Right? It involved 350 put, then the 400 put 2 times, right? Because if you're doing a butterfly, what do you have? You have the outside wings, and then the middle is done twice, right? The 400 put 2 times and the 450 put. And here it tells us there's 79 days left, days to expiration. It's just for your convenience. You have the expiration here, but instead of trying to figure out for each expiration how many days are left, we just put it here for convenience. This one has 79, this has 2, this is 0 DTE. So July 31st, that expired yesterday. Now, also with the put spread, what we have is a put spread itself has different strikes, and the distance between strikes can vary, right? Like you could have, for example, here, 350, 400, and 450. Well, the strikes are all $50 apart, right? 450 is $50 apart from 400. 400 is $50 apart from 350. So that's what this is saying. Strike spread is 50. But you could have a put butterfly where the strikes are much closer together, right? They could be wide, they could be narrow. So for example, this one over here that traded 3,000 contracts, you could see that the strikes are $5 apart. 545, 540, and 535. So that's right here. For convenience, obviously you could do that in your head, but when you're looking through many observations, for convenience, we just put that here. So now you have days to expiration and the distance of the strikes from each other, right? So that's that. Now, if you click on this, right, if we open this up, well, over here also, let's just go through this. I don't have time for the indicators right now, but let's go through this, the VWAP prices. So here we see that the trade price that we interpreted is 29 cents. If we looked at the market, it was the bid. If we interpret it as the put spread, the bid was 27 cents. The ask was 31 cents. And it looks like the trade happened in between the bid and the offer, right? So the bid is where the market prices displayed. If you did it on the market, that would have been the bid. If you did it on the market ask, that would have been the ask. So you could see where the trade price on average, right? Because there are 4 trades. We take the average. On average, traded at 29 cents. But at the same time, the weighted average of the bid and the weighted average of the ask was 27.31. So now we get a sense of where this was trading relative to the markets. Okay. So there, it's right at midpoint, it looks like. And then what was the stock reference? If we weighted by the trades, was 550.48. Okay, so 550.48, which, the stock closed 550.81, close to where the stock closed. And if we want to get more details on it, we open this up. And then once you hit open, you get this window that gives you more information. This is where the current price is. This is where it closed, actually, because we're not open yet. So where was the bid at the last, the last time we took a snapshot? 25 cents. Where was the ask of this? 33 cents. So this is giving us an indication where's the mark to market? Where's the mark to market relative to where it traded? So traded at 29 cents. The market was 25 cents, 33 cents. So the trade is still in between the mark to market, where it's still in between where the last bid and offer was, where we clocked it. Right? Last time it traded was 30 cents. And this is, you could see the VWAP price, low and high. And this shows you the timestamps of the trade, 10/19/43, 200,000. 1141, 16 of them traded, 1141.49, 60 traded, 1147, 40 of them traded. These are the prices. These are the markets at the time. You could see traded on 2 different exchanges, SIBO, MAIEX, SIBO, oh, 3, and ICE, 3 different exchanges. And if you click on it, on these details, you're going to drill down even further. All right, now you got the details of each leg at that time. So, Will, I'm going to, I think, end it right there because we're almost at 9:30.
All right, D. Awesome job. It's my last day in Florida today, so tomorrow I'll be broadcasting from back home in Washington Cross, and it did all the sunshine and palm trees in the background. Actually, discussion came up today about another market, trying to get a MarketChameleon get together in the winter somewhere. People are asking for you to have a conference, but something we have bantered about previously. It's the organization of it all. We don't have a lot of free time to put something like that together would be the hard part, but it is always nice to hear that people would love to do it. So
yeah, no, thank you. We've never done that before. We've never organized or done that like a conference with, you know, like lots of people showing up somewhere. So we'd have to, you know, think about that or see how to even organize something like that.
All right, D.
But
great job, my friend.
All right. Thanks everyone for joining, and stay safe out there, and hope to see you guys tomorrow.
Have a great day, everyone. Thanks, D. Bye.
Bye.